All right, we're going to get started. So, welcome to what is really happening in housing today. Logan, if you're able to explain that, I am going to call you the magician. But we feel like we have timed up this, we've timed up this session very well as we have declining interest rates and increased mortgage applications as if we knew it was going to happen and bring Logan on. But Logan Matashami is Housing Wire's lead analyst. And because of our sponsorship, we have the opportunity to hear his insights today. But Logan is a renowned expert in the mortgage and housing ecosystem, recognized for his insightful analysis and commentary of the US economy and real estate markets. Logan is the leading analyst for Housing Wire and the most influential source of news and information in the US mortgage and housing markets, and is a regular contributor to Housing Wire's daily post. He also is a highly sought after speaker, so we appreciate your time that you're giving to us today and that we were able to make that list, and has spoken at industry conferences, including National Hispanic Organization for Real Estate Associates, New England Mortgage Bankers Conference, and CUNA Lending Council Conference, among several others, and also is on CNBC frequently. His passion for data and economics, coupled with his years of direct lending experience, he was a loan officer for 17 years. We were talking about that backstage, provides industry professionals with critical insights into the ever evolving mortgage and housing landscape. So, Logan, the show is yours. Thank you again for joining us, and thank you for Housing Wire for your partnership. And we'll let you jump into what really is happening in housing today. Yes, got
Okay, there
you.
we go. All right. Okay, Logan Motoshami, lead analyst for Housing Wire. Some of you know me as the chart daddy. I'm here today to basically make a lot of sense of what's really going on with the housing market. There's a lot of bifurcation in the data today. So we're going to streamline all the economic data into one presentation. And my job is to make it so easy for you that you can go back to your clients and you're going to know more about the housing market than 99.9% of the people on planet Earth. Next page. And of course, if you wanted all the data, Wall Street comes to us, real estate investors come to us, realtors, loan officers, you can get all the economic data that I provide, especially our weekend tracker data that's very popular. It'll be part of the presentation today. Here's a QR code to go into the sign in. But let's start what's really going on in the housing market. Next chart. Now, this is my favorite. I always say that the 10-year yield and 30-year mortgage rate have been a lovely couple since 1971. They've been slow dancing, as you see here, for decades. Now, sometimes they slow dance close, which we like, and then sometimes they slow dance far apart, which is what we don't like, what we see right here. But what drives the 10-year yield is what really drives mortgage rates, and then we work off the mortgage spreads within each economic cycle. And 65 to 75% of where the 10-year yield can range in within an economic cycle is really Fed policy. And then we do nominal growth, inflation expectations, what happens within each economic cycle. So what is occurring right now in the last few years looks pretty normal to me with Fed policy. But we always wanted to highlight this because I think a lot of people are confused about what drives mortgage rates. And, a lot of people think that, well, federal debt is so big and mortgage rates have to go higher. I always like to remind people back in the 1990s, when I had blonde hair, debt to GDP was lower, debt was lower, the deficits were lower, but the 10-year yield and mortgage rates were much higher just because nominal growth and Fed policy was much higher back then. So where we are right now, where we're going to go in the future is what my job is to explain to you today. Next chart. Now, this is the 10-year yield in the last few years. What has occurred is I have a little thing called labor overinflation. Back in 2022, Jerome Powell came on TV and he said, we would like Fed policy to match 3, 6, 12-month PCE inflation. Well, that was really bullish because the growth rate of inflation was going to come down because global pandemics are very inflationary and then they're disinflation. However, they changed the game plan for the end of 2022. And I said, okay, It's going to be labor over inflation. The labor market really has to get weaker before the 10-year yield and mortgage rates start to fall down. So that little dive that we saw, especially last Friday, is because the labor report was missed estimates and we had very big negative revisions. But I always like to remind people that a lot of people say, well, last year the Fed cut rates and mortgage rates went up. Well, mortgage rates also were at 8% in 2023 in October, and they got down to 6% in 2024 with no rate cuts. So we have to realize that Fed policy can move things, but the bond market typically goes higher and lower. Sometimes they get ahead of the Federal Reserve. They price a recession or economy weakening. That's what we saw last year. We were pricing way too much economic weakness. Now we still have a little bit room to go lower if the economic data does get softer. So it's going to be a battle between softness of economic data and what happens with the growth rate of inflation over the next few months. It'll be very interesting. But where we are today, year-to-date lows with mortgage rates after that last jobs report looks perfectly normal. Next chart. Now, this is something that I've learned over the last few years doing the Nerd Tour. You know, being a nerdy, geeky person myself, I just assume everyone knows mortgage spreads. But every time I go to a conference and I ask everyone, does anybody know what are mortgage spreads? And not a lot of people raise their hands, mortgage or realtor. So mortgage spreads is the difference between the 10-year yield and 30-year mortgage rate. That's the slow dance that I talk about. We want a more intimate slow dance between that relationship. However, what happened is what does happen between mortgage spreads in many economic cycles, rates go up very fast, early payoff risks, markets are very volatile. The spreads do get worse. And I always like to add here, mortgage spreads got to the worst levels in 2023 after the Silicon Valley banking crisis. So this was a detriment. We would not have had 8% mortgage rates in 2023 if that wasn't the case. But historically speaking, you know, when the Fed starts cutting rates and volatility compresses, the spreads do get better. Now, there wasn't a lot of us in 2024 that, believe that mortgage spreads will get better because they believe that spreads can't improve unless the Federal Reserve starts buying mortgage-backed securities. That is not true, and that has not been true for many, many decades. Mortgage spreads improving in 2024 and 2025 has been a very big blessing. I would give you an example. If we took the worst levels of the spreads in 2023, mortgage rates are 75 basis points higher today. Now, normal spreads in the last, I would say 10 to 15 years is 160 to 180. So we still have a lot of room to go down. We could have sub 6% mortgage rates if spreads just get back to normal. So the fact that we see this improvement is really one of the biggest reasons why mortgage rates are year-to-date lows today, with the 10-year yield being around 422. So this is something that I track every single weekend. I track the 10-year yield. I put it as part of our tracker so we can keep everybody up to date about where mortgage rates are going, what's the 10-year yield doing, and what are the spreads are doing, because we could have sub 6% mortgage rates today if the spreads just get back to normal. Next chart. Now, if I believe in labor over inflation, then the labor market does have to get weaker. Now, the unemployment rate in America has gone up from the lows in the past, but that's mostly due to the labor force growth picking up. More people are looking for work, so naturally the unemployment rate will pick up in that fashion. So that was, in a sense, maybe a positive that the labor market looks like it's getting softer. Now it's reversed. What we've seen now is that the reversal in the labor force growth means that the unemployment rate can stay lower than what would previously expected. Now, we had a very, very negative jobs report. It wasn't just the headline miss, it was also 3 straight months of not only missed estimates, but missed negative revisions badly too. But normally, if the labor force growth was growing a little bit faster, the unemployment rate would be 4.4, 4.5%. If the Federal Reserve had this last jobs report 3 months ago, they would have cut rates. I mean, it was that bad. And already this week, I call it the Fed mutiny. We have a top 10 business news podcast, Housing Wire Daily. It comes on 4 times a week. Tomorrow's theme is the mutiny against Powell. We already have 3 Federal Reserve officials already saying, hey, listen, we need to cut rates. We might need to cut rates more than 2 times. And the economic data was very, very disheartening. So that's a positive going out in the future, because if the economic data still stay soft. You could get a more dovish Fed. And again, 65 to 75% of where the 10-year yield ranges is Fed policy. Next chart. Now, this is the real estate version of the labor market tied to my economic cycle work. Traditionally speaking, when real estate labor, construction labor goes into a recession or starts to fall, we are typically on a verge of a recession. This is the specialty trade contractors. As you can see here in the chart, this has been rolling over the last few months. What you never want in a US economic cycle is manufacturing jobs being lost and residential construction labor being lost out here. And the next chart will actually show why. Because purchase actually, we'll go one more chart forward. Actually, let's go back to the last two. One more. This chart actually, if I take this back all the way to a few economic cycles, residential construction workers always lose their jobs before every single recession. It's what I call is the cheat code, right? And the cheat code is that not a lot of people know this. They keep on calling for a recession, and this never is actually broken. If you actually could look at here, we've had so many recession calls. You know, if it wasn't for COVID, we'd still have the longest economic and job expansion. There's another form of residential employment, which is even more tied to single family construction, multifamily, and remodeling. And I take that back a few decades, and this always falls before every recession. So right now, it's the first time since 2010 that I've seen residential construction workers, residential specialty contract workers, and manufacturing all losing their jobs together. That is a very, very bearish economic signal right there. This is why I've always said the Fed is going to wait till the very last minute until they see the labor market break like we're seeing right now. Then they might get a little bit dovish. So it's going to be very interesting to hear more Fed presidents maybe going against Powell. Of course, we're going to get a new Fed chairman coming up. One of the Federal Reserve governors is resigning in a few days. There'll be another person. There's going to be a huge push on more dissents as this data line is getting weaker. Next chart. Now, this is the confusing part of housing data today. This is the purchase application data that the MBA provides every single week. If I told you we had 27 consecutive year-over-year growth prints, the last 14 weeks have had positive year-over-year growth prints up to double digits, between 10 to 25%. A lot of people go, oh my God, home sales should be booming. I mean, it's really, it's always a positive sign to see double-digit year-over-year growth. Well, part of this is that this data line was working from the 1990s. It was really the lowest bar in history. So the year-over-year growth that we're seeing today is basically a function of more new listings coming. So we always say this, a very simple model for everyone: 70 to 80% of home sellers are buyers. 2022 or 2023 and 2024 were the two lowest new listings data ever recorded in history. 2025, we got something back to normal, not quite back to normal new listings, but good enough to where as they grow, more people apply for mortgages. That explains the year-over-year growth. The week-to-week data is not as strong, but typically speaking, when mortgage rates get between 6.64 towards 6%, every time after 2022, the housing data improves. So we've officially broken into that sub 6.64% mortgage range. I actually wrote an article today about it where I highlight taking all of our tracker data going back to late 22 and explaining that we're not just throwing that number up there. We have a series of data line that tends to improve when rates get down to 6%. Now, we've had this happen before. However, what occurs is that mortgage rates then just shoot right back up and the momentum is taken away. So this is very encouraging that you have a lot of sellers that are really to fill out an application. They're just waiting for that buyer. When that buyer comes in, that seller then becomes a buyer, and then that's how you get sales to grow. And that's how housing economics works. People don't ever think of it that way, but most sellers are buyers. That seller sits, waits, another mortgage buyer comes in, then they sell their house and they go buy, and transaction volumes can rise. We are working from the lowest levels ever. I mean, I am not kidding you when I say that. If I adjust this to the workforce, existing home sales are at the lowest level, and we'll have some charts to go over that a little bit later. Next chart. Now, part of our weekend tracker is that we have weekly pending sales. These are homes that go into contract that will be part of the existing home sales report 30 to 60 days later. Recently, we've actually shown some year-over-year growth. Now, I would argue that we have the lowest bar ever to show growth, but these weeks that are showing positive, they will come into August and September, and this is kind of before rates broke into that 6.64. So that's encouraging to me that even with home prices where they are, even with elevated rates, even with taxes and insurance, our weekly contracts, that's a few months ahead of the NAR, is actually picking up. That's without rates breaking before 6.64%. Now that we're here, we're going to keep a closer eye on that data line. But this to me, not a lot of people track housing this way. This is why Wall Street likes our work, but we see some positive trends. And if mortgage rates could just get down to 6 and hold, we could get some sales growth. Next chart. Now, this is also our total pending sales data. This takes the sale ranges almost in a 4-week moving average. What we saw last year ahead of everyone else is, if you could see this, when mortgage rates were getting down to 6%, our total pending home sales data was actually really picking up and it was diverging. Last year was really confusing because the purchase application data had no year-over-year growth. Our week-to-week data was getting stronger, but no year-over-year growth. So everyone kind of discounted it. But we're like, nope, our pending sales are actually picking up. We're going to see a couple 100,000 more home sales. That's what happened. In kind of late 2022, when mortgage rates went down to 6% back then, we had one of the biggest month-to-month sales prints ever recorded in history. It was almost 500,000 for just 1 month. We had 12 weeks of positive weekly data, and our tracker said, okay, it's going to pop up. It all ended up coming in 1 month, and that was the peak of sales. So we have a very keen eye of being ahead of the curve. That's our motto. We don't want to work with old stale data. Case-Shiller's old, the NAR report's old. All these things are backward looking. We want to look at this in a current and forward-looking way. Next chart. Now, this is existing home sales. The gray bars are all recessions that we've had since 1968. If you notice something here, when a recession happens, guess what happens? Rates go down. When rates go down, then demand starts picking up. Recession, rates went down, demand starts picking up. Recession, rates are down, demand starts picking up. Now, the 1980s is a really good example. Housing was less affordable back in the 1980s. We had more inventory. We had 2 recessions back then. We had 18% mortgage rates. But back then, a lot of people, after the crash in sales, as you can see right here, it looks a lot like this. Sales aren't crashing anymore. You find that base, and then rates go lower and sales rise. And this has pretty much happened in every housing cycle we've seen post 1968. But this one is the closest thing that I could compare to this, because housing was less affordable then, but mortgage rates went from 18 down to 13%. Wages grow, household formation grows. And even now, when we think about existing home sales and new home sales together, if I put them together, it's near 5 million total home sales. The peak in the last decade was near 6 million. Okay, so of course, existing home sales picked up a little bit during COVID, but we're missing roughly 1 million mortgage buyers, even with prices and rates and taxes and insurance. So the history of housing economics shows us that after a while where demand slows down and stays flat, when rates fall, after some time, demand picks up for a few years. So this is why wages increasing, household formation, dual household incomes, these things are really important for housing economics. This is why the demographic factor is really important. I usually have a skit in the last decade. We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids. Dual household incomes, that's when people typically buy single family homes. Nothing has really changed except we do things a lot later in our life. We get married later, we have kids a little bit later. So the housing cycle has to adjust itself to some models, but we are working from extreme low levels. It doesn't take much to move the needle. In the 1980s shows us that even with affordability worse back then, even with credit data a lot worse back then, even with mortgage rates still at double digits, home sales can grow. Next chart. Now, this is the total active inventory of the NAR. This is much different than how we track inventory. We track inventory raw, fresh, weekly, homes that are available for sale. The NAR and a lot of other people track their active listings that are also tied into pending contracts. So their numbers are usually higher than ours. But if you look at the multi-decade NAR, what do you see? We've had periods of time where we have rising sales, and rising inventory, rising sales and rising inventory, rising sales and rising inventory. And what happened here? This was the housing crash. If I look back in the history of housing economics post World War II, if I take 2007 and 11 out of the equation, there's only been 2 years that home prices actually fell nationally. 1990, it was 0.7%. 1991, 0.2%. It's very rare to have nominal home prices, but a housing crash was, look at that, vertical. So home sales peaked in 2005 and they got to the bottom in 2008. Here, what's the difference? Like, how did things change so much? Here's the fastest crash in home sales, 3 years of the lowest home sales ever, and we're not even back to the 5-decade average of inventory. Normal inventory active NARs between 2 to 2.5 million. We're 1.53 millions. We are at the lower levels of 2019. And the NAR's inventory typically peaks out around June, July, and August. So there's not much time left for their inventory to grow. And then we have the seasonal decline that we see every year. My belief is that in 2010, when qualified mortgage came in, and this is my model, everyone is legit now. Majority of people get 30-year fixes. If 70 to 80% of home sellers are buyers, what creature buys a house and doesn't give you one? It was the biggest home buyer from 2013 to 2025 on a percentage basis. Millennials, they only lost their title 2 of the last 13 years. That's when mortgage rates got to 70%. Millennials started to buy in 2013. So if you look at this, right, if 70, 80% of sellers are buyers, if millennials are buying homes, it's easy for inventory to go low. My concern always for years 2020 to 2024 was that was going to be the biggest housing demographic patch ever recorded in US history. Ages 28 to 35 were the biggest. This was the period in time where they actually kick in a little bit. So my fear was that, what if inventory actually broke to all-time lows? Wait. That's exactly what happened. So for those who follow my work, I was like, oh my God, this housing market is really unhealthy. In 2020, when everybody was hoarding toilet paper, I was worried about prices escalating out of control. Well, unfortunately, it did. I mean, our own Altos data that we provide to everybody, our total active listings in March of 2022 were only 240,000 single-family homes available in America. Like, if you think about, we're over 330 million people. We have 162 million people working. When you only have 240,000 single-family homes available for sale, it is savagely unhealthy. Why? You have too many people chasing too few goods. So in this context, we needed higher rates. It was one of my early calls in 2021 that we need higher rates, because this is not the housing bubble of 2005 where we have vertical inventory and distressed sellers. Everyone is looking really good. Here, the biggest crash in home sales, 3 years of the lowest home sales. You not even get to the bottom end of the 5-decade average. Why? Most sellers are home buyers. People don't usually sell their homes to be homeless, right? Those are what crazy people do. So everyone is doing good. Our new listings data really shows that the inventory data looks a little bit different. We'll talk about that. But this gives you a scope about how inventory works in America using the NAR data. And just remember, most sellers are buyers. If first-time home buyers come in, this is why inventory roughly stays stable between 2 to 2.5 million. The only anomaly period was the housing bubble crash years. Next chart. Now, of course, our inventory is a little bit different. We track single family. Now, here it is, the slope of the curve. We're totally nerdy people. We love slope of the curve economics. This was March of 2022. By, I think it was February of 2022, I threw up. I just give up on the housing market. It's so terribly unhealthy that we need to get rates so much higher to blow this up. So higher rates leads to higher inventory. Why? Because it takes longer to sell. And then you retract buyers out there. That means those millennials aren't buying. So it allows inventory to breathe, right? So here we are. So much growth on a percentage basis in 2025. No home prices crashing nationally, right? We don't see any stressed sellers. This is the most healthy aspect about housing in 2024 and 2025, was getting inventory back to a normal place where the supply and demand equilibrium works. All right. And even though we're not back to normal inventory levels, this is good enough to make it a more balanced marketplace, and in a lot of markets, a more buyer marketplace. Sellers had way too much power, and it's not good for anybody when home prices escalate out of control, because all it does is kill future demand. So for myself, 2024 and 2025 are remarkably more healthy than what we saw in 2020 to 2022, where home prices, and give you an example, home prices were up 10% in 2020. Home prices were up 19% in 2021. Home prices were going up 18% in 2022 before rates rose. It finally came down to being only up 6%. But imagine if rates didn't rise, it would have been terribly bad for everyone. And just to give you some perspective, you know, the hottest home price growth period was actually 1943 to 1947. Not a lot of people know that. Another period, home prices were much hotter from 1974 to 1979. Both periods had inflation, but 1977 and 1979, home prices rose faster than 2020 to 2022. But this is our inventory. Now, we can do this for every single zip code, city, and state in America, but this gives you an idea of raw, fresh, single-family homes that are coming onto the market. No contracts, no nothing. The growth is, we take the channels all the way to the seasonal period and then the seasonal declines, but we are ahead of everyone else. This doesn't come into any of the other data lines, and this is fresh, single-family listings out there. Next chart. Now, another thing that not a lot of people know is the price cut percentages. Like 1/3 of all homes in America always have price cuts. Very unhealthy here, right? This was the 2022 level. I think at one point in 2022, 87.3% of the homes in America had multiple bids. And we're not talking like 3, 4, 5 bids. We're talking 20, 30, 40. It was so unhealthy. I remember seeing a house in Southern California and there was 247 people in line. It wasn't even that great of a house, but there's just not a lot of homes. Hungry Hungry Hippo, the game in the 1980s. If you guys remember playing that, just think of, you know, just one ball out there for all those hippos. However, price cut percentages are increasing, healthy, supply and demand equilibrium. Sellers and buyers are working in a more functioning marketplace. Sellers had way too much power here. One of the happiest things I see is this data line picking up, right? Because how affordability is going to improve. You're not getting 3 to 4% mortgage rates, right? So wages grow, price growth cools down. Those are all benefits for future growth of housing, you know, and we saw that in the 1980s where you had such a massive rise of home prices from 74 to 79 and yet 18% mortgage rates. But as mortgage rates came down, price growth cooled first. It leads the way for affordability to get better. So this, again, for me, another positive data line, not just for this year, but for going out for many years. Next chart. Now, this is one of my favorite data lines. This is our new listings. It looks very scribbly, but every single week we have people apply their homes into the market, and this data line tracks. We could do it for every city, zip code, anywhere in America. These are homes that come to the market that do not have a contract. All right. Normally speaking, the seasonal peak period you see here, we got between 80 to 110,000. Really, 80 to 100,000 is normal, like from 2013 to 2019. From 2008 to 2012, I mean, one of the reasons why these housing crash, national home price crash people, they don't have the data. This data line was running at 250 to 400,000 per week for years. Even if I took the peak 91,000 in 2022 and doubled it, we're not even close to the bottom end range of what was going on back then. Why? Forced credit sellers that weren't going to be buyers. That's the difference, right? You're putting a home in the market and you have no attention to buying because you don't even have control of the process. You're a foreclosure, you're a short sale, right? You are a seller that is going to not be a buyer. That's what happened from 2007 and 2011. This is why we have 82 years of housing economic history post World War II. I could model out what happened back there. Here we are, third calendar year of the lowest home sales, taxes, insurance, all these things, new listings data barely got to the low level of what we would see in a normal marketplace. Usually it's 80 to 100,000. We got up to 80 a few times this year, but we never really trended up there. The peak was actually in May, and it's slowly doing its seasonal decline. So when we see stress in the housing market, we'll be the first people out there to see it, and we don't see it yet in the systems. We try to warn everyone late 2022 that, you know, new listings data was actually declining in a faster rate on a year-over-year basis. So you just don't have those rush of sellers. So this is why we always teach people this. Mike Simonson, who's the founder of Altos, I always tell people this is our famous story. In 2007, Mike went up to Lehman Brothers told Lehman Brothers, hey guys, we have a way of tracking housing more prolific than anyone. We think the housing market's breaking. Lehman Brothers said, I don't know who you are. I got 85 analysts. Go away. Mike walks 30 feet, sees Goldman Sachs. Goldman Sachs takes the data, reads it, buys it, shorts the housing market, makes $10 billion. Lehman Brothers went out of business next year. We believe we are the most prolific housing data miners on planet Earth, and we are not shy about it. We'll debate anybody on it. We have the data line sets, but we want to teach this because you can be a better real estate agent, a better loan officer, and explain to everybody, and you can even break everything down to your zip codes and sound super smarter than most people out there. Next chart. Now, this is one of my favorite charts of all time. When I die, it's going to say Chart Daddy, and it's going to be this picture on there. This is the foreclosure and bankruptcy chart. Actually, this was updated yesterday. When somebody tells me it's housing 2008, I go, homie, look, it's not 2005, it's not 2006, it's not 2007, it's not 2008. We had 4 years of credit stress building up before the 2008 recession. That's how terribly unhealthy and crazy the housing market was, that you would have rising foreclosures and bankruptcies in an economy that was actually having a lower unemployment rate. The credit markets, right? Just look at the bankruptcy data back here, right? We saw this vertical increase. What happened back then? The 2005 bankruptcy reform law, right? So when I tell young analysts, if I had to teach you guys one thing or tell you what to learn, you go read the 2005 bankruptcy reform laws and go read the 2010 qualified mortgage laws. Those two laws changed the United States economy for the rest of the century because they do not allow people to leverage up anymore without consequences, right? Or regulations. And look at this. All these years that people were talking about foreclosure crises, yesterday foreclosures declined on a quarterly basis. This comes out every quarter, and it's something that we like to highlight. But when we see stress, it's very evident. Too small. I can't get the job done. Next chart. Now, if you look at total delinquencies, these are all the credit data together out there. The 30 days that people were worried about with credit cards, auto loans, everything like that, declined last quarter. And just remember this, that when we see credit stress or stressed home sellers, we see it in our new listings data, right? More people will rush to sell their homes because they cannot financially meet the obligations. But also, it has to be really bad because so many people have such low mortgage payments that even if they sell, they have to rent, in some cases higher than what their mortgage payments. And you got to remember, if somebody bought a house 15 years ago, we've had so many refinancing ways, but their wages, their total income is so much higher as time goes by. This is why you haven't seen any kind of rush of sellers. Think about everything that we have seen over the last 5 years, and we still have the 5 lowest new listings data in history, right? So credit cards, we see renter financial profiles, lower incomes getting stressed, auto loans, these things. But in general context, the credit markets, especially for housing, still looks very stable. Next chart. Now, my counterparts hate my guts across the world. I'm going to explain why. This is the FICO score chart in America. After 2010, when qualified mortgage came in, everything changed, right? In Canada right now, they're doing 90-year loan modifications out there. Your mortgage will outlive your grandchildren. Here in America, this is as beautiful as it gets, right? Majority of the FICO scores, whether there were purchases or refinances from 2010, have been 720 and over. Why? Because qualified mortgage changed everything. Everybody's legit now, right? You have to have the capacity to pay the debt back. And usually the people that buy homes have really good cash flows, and it's been here. This is another reason why you don't see new listings take off. This is another reason why inventory is not even back to the normal decades. Home sellers are doing very good. If they were stressed, we catch it first, but the data here shows it's just not there, right? Other countries, unfortunately, they don't have a 30-year fix. Why? What's the best hedge against inflation? They always say 30-year fixed mortgage. Why? Fixed debt costs, rising wages. In an inflationary period, your wages rise more, but your debt cost stays the same. So many people have such low mortgage rates that it's almost not fair, right? And other countries just don't have our plumbing system, Freddie, Fannie, FHA, all these things. So they can't really remake this. Canada is finally trying to do something like a 30-year fix, but it's not shocking that on paper, the middle class in America has never looked this good, especially homeowners. So you have a lot of positive cash flow homeowners still, and this explains why the new listings data didn't accelerate higher. Next chart. And here's the homeowner vacancy rate. Not a lot of people like to show this chart because homeowner vacancy rate, like the inventory data, went vertical, during the housing crash years. Here, even with the biggest crash in home sales ever, even with 3 years of the lowest home sales ever, we're not even back to normal, right? Homeowners are doing good. This is one of the reasons why I was team higher rates in 2021. So this is not the housing bubble, right? We need to get the supply and demand equilibrium back to normal. The data looks very good. Homeowners look good. They can take it, right? So the majority stock of houses out there are in hands that are very good. So we've seen an increase from the very historic low levels and trying to get back to normal. So now you guys have the visual, right, to see this, and you'll have access to this presentation and you could present it in a way that's very understandable for your clients. Next chart. Now, majority of all homeowners in America also have a lot of nested equity. This is a very key discussion in terms of a lot of people have been running around the internet saying this is going to be a foreclosure crisis. It's going to be worse than 2008. We've had many recessions post World War II in America, a lot. We've only had one foreclosure crisis. The loan to value before the run up in 2008, 55, 57%. The loan to value in 2008 was 85%. The loan to value today in America is 46.9. All of you know what I'm talking about when we talk about LTV. It is 46.29. Over 82% of people have 30% equity. 40% of homes in America don't even have a mortgage, right? How do you have a foreclosure crisis with these data lines? You don't. You don't. And history has shown us in the 40s, 50s, 60s, 80s, 90s, 2000s that you can have recessions and everything, but we had one crisis and that data line got worse before the 2008 recession. We don't have that kind of credit market anymore. I always tell these people they're dancing with a ghost, right? The dancing with the 2008 housing ghost doesn't exist, right? Because the regulations shade. So another big difference here that doesn't get talked about, in 2001, the down payment percentages were very elevated. But from 2001 to 2008, they were getting smaller and smaller and smaller. People were putting less down. From 2017 all the way to 2025, the median down percentage data went up to a 21st century high. This is a very, very key data line. More people are putting more down during that period, less down. So when we think about underwater, it's less than 1% of homes are underwater right now. But when you look at back then, over 23% of homes were underwater. New listings data, underwater mortgages, stressed sellers aren't buyers. Look what happened. National home prices crashed. But that data line looks a lot different than what we have here. And now you have the data to show this, right? Visual charts, teach your clients. Your clients will think, my God, you know so much more than other people. This is why people come to us. Next chart. Okay, so with all this data now, and I will tell people, if you want to follow us, number one, come to Housing Wire, subscribe to Housing Wire. You get access to the tracker. But also, if you really, really wanted to, for your own area, your own zip code, your own farming area, you could go to Altos Research. We give everyone a free zip code. What I just showed you right here is the national economic take. I'm an economic cycle person first, housing second. I'm giving you the national view. We could get very prolific and more defined with zip codes, cities, and states. And that's why Wall Street comes to us, real estate investors come to us. I just gave you a glimpse of what the pie looks like. It tastes a lot better when you get down to your own zip codes or cities because we give more prolific information. So Altos Research is another one. Housing Wire Daily. We have the podcast, Spotify, Apple. We also have the Housing Wire YouTube channel. Sarah Wheeler and myself, we come on 4 times a week. My job is to nerd out 24/7 and to tell you what's going on so nobody can say they did not know. Knowledge is power, right? And hopefully all of you learn something new, because if you can teach this to your clients, you become more confident talking about housing. but your clients also become more confident with you. Now back to Jody.
Thank you, Logan. That's amazing insights.
Excuse me. One last thing. I forgot about this one. This is a QR code for 20% off to the IMB Summit we have in Dallas, Texas, where I will be the main speaker, and we will update everyone and add a lot more charts for that. So if you wanted to join us in that, use this QR code. You could get 20% off. We're going to have a lot of high-end people in real estate and mortgage in that event. Hope to see some of you there. Now back to Jody.
Awesome. Thank you, Logan, and thank you for the insights and information. There were a couple questions that were in the chat. Unfortunately, we are out of time. And Logan did share with us that he answers questions 24/7, maybe not 24/7, but nearly all the time.
I'm telling you, 24/7. If you have questions, follow me on Instagram. We have close to 1 million people now come to my Instagram page, not because I'm cool and I have a lot of fun. It's because I'm a 24/7 chart daddy nerd, and that's all I do with my Instagram stories and posts. So come there, follow me, ask me your questions, and I will give you a video response because I do nothing else but this.
But geek out. I love it. So I did glance up. I was taking notes. I glanced up when you put up the housing inventory, and I thought, oh my goodness, if that's your EKG, we need to rush you to the hospital immediately. But Logan, thank you so much for your time and for your insights. Thank you to Housing Wire and your partnership. And we look forward to continuing to partner. And for everyone that was listening, thank you for your time as well. Have an amazing day.